Hello, welcome to video 5 of the 7 video tutorial series for stage 5 of the company creation project. This video will wrap up what we were discussing previously with the last video on the cash flow statement, and then dive into the next phase of the stage 5 of the project, which is the profit and loss, or otherwise known as the income statement. So I finished off with the cash flow statement, talking about the different types of financing, for the equity versus the debt, and there's certainly pluses and minuses to going either way. And we've got this handy dandy breakdown right here that shows, based on how much money that we raised by the owners versus how much money raised by the venture capitalists in this case, or investors, you could also refer to them as. The percentage of ownership now that is of the company, the percentage of the ownership by the owner versus the percentage of ownership by the investor. So you can see here that the investors actually have a majority stake in the company. They now own, because of how much money they contributed, actually 66.7% of the company. And so that really highlights, one of the drawbacks of equity type of financing as opposed to the debt financing, is that you're permanently giving up ownership into your company, and in many cases controlling rights in terms of making decisions. The debt, on the other hand, is, well, you're taking on debt that you potentially need to pay off, but on the positive end of that is, once it's paid off, the company is still yours. You still own 100% of the company if you went this route. So those are just decisions and things that you want to think about amongst your teams as you decide how much you're going to how you're going to raise this initial capital that you need to. Okay, moving on to the next phase of this stage, like I said, the profit and loss statement, also otherwise called the income statement. So this is part 4 of the stage on your assignment document, and it corresponds to this 4th tab right here on your Excel file. So if you recall back from your book, the income statement is a financial statement that reports the revenues, expenses, and net income that resulted from a firm's operation over an accounting period. And for the purpose of this assignment, that accounting period is 1 year. There's not a lot in terms of decisions that need to be made in this particular stage. You'll notice that the only really number that needs to be inputted is this yellow box right here. However, this is a good opportunity for you to start kind of getting a feel for how the company is operating, and how its revenues and cost are kind of interacting with one another. And one thing that I did want to bring out is that, although with this assignment we're really walking you through each of these different stages, it's not to say that you cannot go back and readjust your numbers. In fact, the intention is that you do go back and readjust your numbers after you get to these later financial statements, based on what you've learned from these financial statements, and perhaps maybe seeing, okay, there might be areas where our firm is not performing as good as we had hoped. Is there some things that we can potentially adjust to improve maybe our efficiency or our profitability? And that's one of the questions that you'll notice is actually addressed in the write-up portion of this particular component of the stage, is that how can you increase profitability for your company? Where areas where perhaps You could increase revenues in this area right here, or perhaps decrease cost. So this first line right here, your gross margin, or also known as your gross profit, this number of 24,000 is basically showing how much money are you making before you factor in your operating, your fixed expenses. But it is factoring in those variable costs of the cost of making your particular product or service. So for instance, some things that you might want to think through is there more an efficient or cheaper way without cutting down on the quality, if that's not the route you want to go, of making your product or service? Is there a less costly way of shipping your product? And if so, how, and that's how you can increase your gross margin here. So it kind of dissects it from the variable cost side of things, or the sales. Is there a way to increase how much we're selling? And then it also breaks it down from more of the fixed expense side of things. Is there some fixed expenses that we can perhaps cut? Do we need to have this many people on staff doing administrative work, or is that something, for instance, that could be covered by the owners, or different things to think about here? And again, that I'm looking for justifications on these decisions. You notice here is this called financing expense. This was not originally accounted for, as I had mentioned. It wouldn't be in your expenses right here. You have your administrative, and you have your overhead, and you have your other. Here's your administrative, your overhead, and your other. This financing expense here is something that, again, for simplicity's sake was automatically calculated, is $210, and where that number comes from actually is from your cash flow statement. If you look that, for this example, I had decided to take on a loan of $2,100. And so the formula that's at play here is it's actually factoring in an interest expense, the interest that I would need to pay on this loan, of 10% of the total loan amount for the year. So if you multiply 10% by 2,100, that's where you're going to get your 210, and that's where that expense comes into play. So you have your operating expenses here, and again, this is something that at this point in time of this stage of the assignment, you and your team may want to think of, okay, is there a way to cut down these expenses? Or maybe, we changed our mind. Maybe we don't want to take out debt. Maybe we are comfortable with giving up some of the equity or ownership of the company. And so this is where your subtotals here. Your net operating income, now that takes your sales and deducts all of your costs. So you had your $60,000 in sales. You got your $36,000 and the cost of goods sold, and then the shipping cost, and then you deduct your operating expenses, and that's where your net income comes into play. Then we've got your taxes already factored in. Again, for simplicity's sake, it's at the rate of 35%. So there's your cost in terms of your taxes, and all of this is based on a year. And that leaves your net income. After all said and done, all of your sales, you deduct all your costs, this is what your company walks away with in terms of its profit at the end of a given period, which in this case is at the end of the year. So now we're finally down to this other decision that you'll need to make after you have potentially adjusted these and these other portions of the Excel file. Is okay, you have the $5,324 of net income. What are you going to do with that? And so you have two really main choices at this point in time. One is you can redistribute it into your company in the form of retained earnings, which basically means you're going to keep it within your company. Or you can distribute to your owners in the form of what's called a dividend. So if you have owners of your company, I assume each of your team members, or perhaps you have some investors. In this stage, you're deciding, how much am I going to pay out and take cash with me, take it outside of the company. And again, there's positives and negatives for this decision. There's also some tax ramifications as it relates to this decision. So I'd encourage you to refer to the information provided in your textbook for sure, and potentially conduct some outside research in terms of deciding, justifying rather the decision as to how much you're going to retain, how much you're going to distribute out to your owners, and then outline what the impact is, especially as it relates to your particular company. This decision will change whether you are, for instance, a sole proprietorship or a corporation or a nonprofit organization. And so that's the kind of things that I'm looking for there. But for the purpose of this demonstration, I'm going to say that I'm going to pay out $1,000 to my owners in the form of dividends, which that will leave $4,324 in retained earnings that will be reinvested into the company. And that is the end of this video. We've got 2 videos left. We've got the break-even analysis and finally the balance sheet.